You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. Republicans have announced ambitious plans to cut taxes and spending this year after winning the White House and majorities in both halls of Congress. President-elect Trump also campaigned on using tariffs to increase federal revenues and protect American industry. But without a filibuster-proof majority in the Senate and with some committed fiscal hawks in the House, Republicans could be limited in how much they can change fiscal policy this year. On today's episode, we talk with Alan Cole, senior economist with the Tax Foundation's Center for Federal Tax Policy, about the coming political fight to renew certain provisions of the 2017 Tax Cuts and Jobs Act, the limits imposed by budget reconciliation in the Senate, and how tariffs impact the federal budget and economic growth. Stay tuned. Coming up soon, our interview with Alan Cole, but first, a quick market update. Payrolls grew 256,000 in the December report this morning, solidly above the 165,000 consensus. The unemployment rate fell from 4.2% in November to 4.1%. Overall, the labor market is showing few signs of weakness that would give the Fed any urgency to further cut rates. There were mixed signals from the other data releases over the last 2 weeks. The ISM manufacturing continues to print in contractionary territory, while the ISM services is reporting consistent strength. The November JOLTS reported low rates for hiring and quits, but initial jobless claims fell to an incredibly low 201,000. Thus far in the new year, FedSpeak has essentially reinforced Chair Powell's December press conference message of patience and caution about future rate cuts. There's a widespread expectation the Fed will leave rates unchanged later this month. The Treasury curve bears steepened over the last 2 weeks, with 10-year yields briefly touching above 4.70% this Wednesday, and 30-year yields hitting 4.96%. Yields rose again across the curve following today's strong jobs report. Term premia have risen over the last month from lingering uncertainty about the economic outlook and the upside risk to Treasury supply. The Treasury market was also sensitive to tariff news over the last week, rallying after a Washington Post article reported the incoming administration was designing a moderate approach to tariffs, then selling off after President-elect Trump denied the report, and then selling off again after CNN reported Trump plans to use emergency powers to significantly raise tariffs. The volatility should continue at least until actual policies are put into place. Mike Johnson was chosen again to be Speaker of the House after a few of his Republican colleagues threatened to withhold support without more concrete promises to cut spending. In the end, only one Republican voted against Johnson, but the process foreshadows the potential difficulties Republicans will have in passing legislation this year with a razor-thin majority. That's all for the market update this time. Now, our interview with Alan Cole. Our guest today is Alan Cole, senior economist with the Tax Foundation's Center for Federal Tax Policy. Alan, thanks for coming on the podcast.
Thank you for having me.
Our topic today is 2025 federal tax policy, what changes we might expect this year, and what the impacts could be on the federal budget. Now, there were a lot of tax proposals we heard from Republicans on the campaign trail, and we will address the main ones in just a bit, but I want to start with the procedural question. Alan, can you walk us through the budget reconciliation process? How does this fit into how fiscal policy is made? And what are the limits for it when one party does not have a filibuster-proof majority in the Senate?
Thanks for the question. Fiscal policy is really constrained by the rules of the United States Senate. And it's particularly constrained when you have a party that's trying to go it alone, act by itself without much or any help from the other party. There's a 60-vote threshold to avoid the filibuster, in which the minority side in the Senate can kind of delay things essentially indefinitely. And so usually that 60-vote threshold isn't reached because usually one party cannot get more than 60 seats in the Senate. It's happened only rarely this century so far. So if you're trying to go it alone without help from the other party, you probably don't have 60 votes. And that means that for a budgetary legislation that might otherwise be filibustered, you have to go with a different process called reconciliation. And there's a couple of special rules, and we'll kind of stylize them a little bit. The first thing you have to do is put a big number on your forehead that says, this is how much we're willing to increase the deficit by. And you can imagine that senators don't really like having that number put on their forehead because it's an easy way of kind of pointing to someone as being irresponsible. Look, he said he was going to increase the deficit by that much, and then he did it. So that's a very difficult part for congressional leaders to deal with. Once you pick that number, and you could pick a really high number in theory as long as you want to take the heat for it. But if you pick that number, then you can increase the budget deficit by up to that amount over the next 10 years, over the 10-year period following your legislation. Then in the following years after those 10, we could call those the out years or the ones outside of the budget window, there you can't increase the budget deficit at all. And this is kind of a Senate rule that's intended to make it difficult for people to increase budget deficits too much without enough of a mandate from Congress to do so. And one could debate whether that's a good idea or not, but that's how it's structured. The result of that is sometimes we get legislation that is scheduled to suddenly expire because people were trying to conform within these rules. And that's the situation that we are set up for in 2025, and it may well happen again that we have a temporary bit of legislation on the individual income tax.
I think that's a perfect segue into talking about the Tax Cuts and Jobs Act, the TCJA, that was passed during Trump's first term, because it's on the radar again this year. And I feel like this theme of budget reconciliation is going to be pretty consistent through the rest of the talk. And so what are the major provisions that are going to sunset this year? And to go back to that procedural question, is this separate from the continuing resolutions that keep the government funded? What are we looking at with the potential renewal of the TCJA this year?
The TCJA stuff is likely to be separate or at least kind of mostly debated separately from the general funding of the government. That's also a kind of frequent cliff that Congress runs into, sometimes argues over, sometimes has a shutdown. The last one did not last very long. That's another ball in the air that Congress kind of has to keep batting back up in the air, and so is the debt ceiling. Sometimes these things all coincide into one big fight, and sometimes they don't. With the TCJA expiration, that's a much kind of longer time frame one. That's not something that gets fought over, every couple of years. It's something that gets fought over every decade, roughly, because of the kind of 10-year budget window for reconciliation that Republicans in Congress in 2017 figured out how to redesign the tax code in a way that they wanted, and they could use the budget reconciliation process after naming a number. Back then it was about 1.5, 1.6 trillion, something like that. They could use the budget reconciliation process to make their individual income tax cuts okay within the 10-year window because they pinned the number to their forehead and said, this is what we're going to spend on it. But once you get past the 10-year window, you can't make permanent legislation without the promise of budget neutrality, and that they really couldn't do for the individual income tax cuts. So they gave us the TCJA tax cuts up until now, and now is the time that we need to debate their extension. There's an aside, there's the corporate income tax, and the reason I'm not talking about that quite as much right now is that Republicans in 2017 were able to set their new corporate income tax on almost autopilot. They made a lot of changes, a lot of them raised revenue in addition to the rate cut, and they were able to make those things mostly balance out. It wasn't perfect, and so there are some additional scheduled tax hikes on corporations that'll happen this year, but the corporate side is mostly set, and there's no compelling tax cliff coming. on the corporate side. But meanwhile, on the individual side, we've got a lot of stuff expiring. The biggest things that affect basically everyone are the changes in the standard deduction and the child tax credit. Those are going to affect a lot of people. The standard deduction was doubled and indexed to inflation, so the numbers from 2017 aren't the same numbers that we see today. But should the TCJA expire, the standard deduction will once again be cut in half and kind of restored to the previous path that it would have been on if the TCJA hadn't happened. So that would be a tax hike on a lot of people. We think probably around 65% of taxpayers would get some sort of tax hike from the expiration of the TCJA that would actually be significant. And a fair number of those taxpayers, maybe most of them, would experience that hike through a smaller standard deduction. There's also kind of people for whom the tax burden wouldn't be changed too much. There are some people who just don't have very much income tax liability because they're kind of close to zero, both in the pre-2017 system and today's system. And so there's maybe a third of Americans who wouldn't have much of a change either way. And then there's a small minority, mostly in very, very high income states and high property tax parts of those states, and maybe they're homeowners and they have mortgage interest and property taxes. That very small minority, they might actually be kind of looking forward to TCJA expiration because they would actually be a little bit better off under the pre-TCJA system because they would like to be able to deduct more mortgage interest and property tax.
I want to address that state and local tax deduction, or SALT, a little bit later. But I'm curious, you mentioned the price tag that congressional representatives kind of proverbially put on their forehead before they go through the budget reconciliation process. What can we say about the price tag from TCJA? And is it the Congressional Budget Office that comes up with an analysis that determines whether legislation is going to be around that price tag? Because I think right now, if we've seen anything from just Mike Johnson's re-election at the beginning of this year for Speaker of the House, it looks like there's some pretty serious fiscal hawks in the Republican Party with their razor-thin majority that might not want to renew the TCJA if it means expanding the deficit more.
Yeah, I think Mike Johnson has a very, very tricky line to walk. We saw already how he had to white knuckle it a little bit just through getting voted in as speaker. And we kind of know from past experience that Republican speakers often have trouble controlling their caucus. And there are real disagreements of substance on how to go forward with how much of a number do you want to pin to your forehead? How much do you want to increase the deficit? And the official counter of these things is kind of the Joint Committee on Taxation and kind of the Congressional Budget Office. The Joint Committee on Taxation essentially does all of the work on building up tax models and doing a lot of that tax modeling. But then if we're talking about rolling tax policy changes into kind of a larger all priorities of the Trump first term reconciliation bill, and that's something that has been discussed, also kind of trying to roll some immigration and other things all into one big bill. If you have that, then the Congressional Budget Office might play a bigger role in the non-tax elements, and then you'd see kind of the final number being submitted by the Congressional Budget Office, but with substantial work from joint tax on the tax parts. So they're going to get that number. And you'll find that some Republicans, enough to matter, are sincere fiscal hawks. Some, enough to matter, are interested in preserving certain policies that other Republicans might want to get rid of to pay for tax cuts. There are Republicans who are interested in, for example, preserving the state and local deduction. There are Republicans who are interested in preserving, say, tax credits from Joe Biden's Inflation Reduction Act. But a lot of other Republicans might want to keep curbing those deductions in order to help pay for tax reform. So I think you're going to see real issues where there are disagreements of substance, and you've got this very small majority. So any one of those factions could kind of make threats to walk away.
I want to revisit that idea of budget reconciliation because it seems like there are two fiscal priorities of Republicans in power that run parallel but might not necessarily happen at the same time. So there is renewal of TCJA, and then there is this effort to cut spending. There's the Doge unofficial committee, but really just an overall mission to get the deficit under control. So can budget reconciliation happen twice in a given year? Can it happen, whenever Republicans kind of want to fine tune fiscal policy, or do you have a limited number of attempts in a given fiscal year?
You do have a limited number of attempts, but there are some ways of doing it twice. I don't quite have the Senate expertise to be able to explain exactly why that's true, but there is the ability to do one bill or two bills. You really don't want to do three. That's not really a thing. And we actually saw that in part of the Biden administration, the Inflation Reduction Act. While that was being debated, there was a point at least where it would have been the second in a year, and they found a procedural way to make that work. So it can happen, but it's apparently a little bit tricky, and you would not do three reconciliation bills in a year. So the discussion has been kind of, do you do one bill that has everything, or do you have one bill that does immigration and other such things, and one just for tax?
I also want to point out, though, because it has to do with fiscal policy, can immigration be included in a budget reconciliation bill? I know there are often times where there's confusion and the Senate parliamentarian has to decide, well, is this just, policy, or is it fiscal policy? So are there things tied into immigration that we could assume will be a part of the budget reconciliation bill?
My impression is that immigration does have a reasonable impact on fiscal policy, and that means that it can be scoreable. And often, once a thing can affect the budget, you actually can include it in reconciliation because, hey, you want to count the budgetary effects of your stuff for the purposes of this whole reconciliation vehicle. That's kind of my understanding of it, but it's certainly you need to be very, very into Senate procedural rules to know with any certainty what could be in or out. But I definitely think some immigration is probably doable within reconciliation.
Any big fiscal policy, there's going to be the estimates from a lot of organizations about what the deficit impacts will be, either directly from the tax and spending changes, but also how the economy responds dynamically. So, do we have any good estimates for how that first passage of TCJA impacted the deficit and economic growth? And what do we think it could mean in 2025, given where the economy is right now? If it's renewed or it's not, what will the impacts on the deficit and growth be?
There's definitely going to be a greater deficit, and there are some reasons to think that budget deficits are bad, especially right now. But there's also some improvements to the incentives for business to invest that are part of the TCJA as well. And it's a little bit, how much do you do one versus the other? The Congressional Budget Office's models, when they do dynamic scoring, when they account for growth impacts, those models really don't like budget deficits very much. There's a supply of saving around the world, savers who are willing to lend to governments or to entrepreneurial projects in the US. And the more that they're lending to the government, kind of the less that they're lending to entrepreneurial projects. There are some other frameworks that you can look at that kind of produce this same basic insight that kind of budget deficits make interest rates go up, and interest rates going up means higher cost of capital for business, and that's bad. And that's kind of a core Congressional Budget Office model insight. It's one of the strongest effects in their model. But there are some improvements to corporate incentives in TCJA as well. So if the kind of budget deficit impact is bad, the ability to write off capital expenditures immediately. You deduct the full value of the capital expenditure immediately rather than over several years. That's a good change because it kind of improves the present value of the deductions that you make on an investment. And so it makes the investment a little bit more worthwhile, even though you'll eventually be taxed on the return. The deduction up front is good, and that kind of overall incentivizes a bit more business investment. So that effect could improve investment. So it's a little bit how do you weigh those two in general, and then a little bit kind of what provisions get renewed or not renewed. And Congress has the opportunity to renew expensing of investments, both physical and R&D, and those would be pretty pro-growth changes. But larger budget deficits, maybe not so good. We saw kind of after the bipartisan COVID spending under the Trump administration, followed by a relatively dovish Biden administration, we saw that we got really high interest rates, kind of as the CBO model would predict. And that wasn't very good for a lot of people. And it wasn't very popular. So there are some drawbacks to making the deficit number too large, but it's hard to decide kind of what makes the cut and what doesn't.
When you look at the possibility of TCJA being renewed this year, does the Tax Foundation or any analysis that you really rely on give an estimate for what the deficit impacts will be? Because as we were talking about, there are so many dynamics about how the economy changes to the tax code. And so even when there is a tax cut that in a first order way can lower revenues, if it increases economic activity enough, that hit won't be as tough. So when we're just looking at the deficit, how are you thinking about renewal of TCJA this time around?
We think that overall, renewing kind of all of the provisions of the TCJA that everyone likes, that would probably be about a $4 trillion proposition over the next 10 years. So they would have to pin the number $4 trillion to their foreheads. And your mileage may vary on whether you think, yeah, I'd be willing to do that in order to bring a tax cut home to my people, or no, that seems like a lot. But 4 trillion is roughly what we think it might be. And I think a fair estimate of if the good provisions on business investment are continued, and you get kind of the optimistic case for growth, you could maybe shave about $500 billion off of that cost and say more like $3.5 trillion after accounting for growth. But in any case, it's going to increase the deficit. This is not a tax cut that will pay for itself.
Something you brought up earlier is the state and local tax deduction, SALT. So what did the TCJA actually change about the SALT deduction? What is it, and how does this all tie into state and local financing?
The SALT deduction is the deductibility of either state income taxes or state property, and state sales taxes and stuff aren't really tracked and can't really be put into state and local deductibility in general. It doesn't work as well. It's a little bit more about income and property tax heavy states. And then the kind of property tax heavy people within those states. The kind of issue of the standard deduction, if your itemized deductions are kind of small, if they don't account for as much as the standard deduction would give you, then none of this matters to you. And that's actually most people at this point, because of that doubled size of the standard deduction. Most people don't really pay attention to this issue, but there's kind of a small minority, but critically a concentrated minority who do care. And there we're looking at kind of people who are at work in relatively strong centers of business, often on the coasts, and then say have a high value home in those metropolitan areas. And they might pay a lot of property tax. They might pay mortgage interest, which also kind of increases their itemized deduction total. And for them, itemizing is the way to go. And the TCJA limited the deductibility of state and local taxes to $10,000, no more than $10,000. And so that could be, a huge difference if you're, say, a investment banker in New York and you pay functionally a low double digits tax rate to New York City and New York State on your income, and it's millions of dollars of income. Well, then clearly you would love to be able to deduct hundreds of thousands of state and local taxes, and that ability is actually probably more important to you than the reduction in the top rate that TCJA gave you from 39.6% to 37%. So there are people who care about this more. And even at a lower scale, there are people who care about it because, say, they own a very expensive home, and that's where a lot of their income has gone because they're kind of in a nice suburb in, say, New Jersey or Long Island, and they still got very high taxes on that. So that concentrated minority of people who care about state and local taxes, they have a lot of influence over representatives from, say, well, certainly the urban areas themselves, but those are mostly Democratic strongholds. But when you get to the suburbs of New York City, you'll have people who have functionally a blue state earnings profile and income tax profile, but a red representative. So kind of 3 to 6 districts in New York where people care a lot about the state and local tax deduction, maybe a couple in California, and maybe 3 in New Jersey. You could call those people kind of the SALT caucus, and they will be one of the constituencies that Mike Johnson will have to navigate in getting this bill done.
I understand how that SALT deduction is the most relevant to people who are high income and in high tax jurisdictions. But I'm kind of curious, the spirit of the SALT deduction, I've got to imagine, is to incentivize or at least ease the burden of states and local jurisdictions of raising revenue. So when we change or limit the SALT deduction in the tax code, does that mean that cities and states have not been able to raise revenue as easily, for better or for worse?
I think you have to assume that there's some effect there. If you're a state and you're taxing SALT deductible taxes, then it's a little bit like the federal government is refunding your taxpayer between a quarter and a third of the money. So the burden of taxes is felt a little bit less by the state taxpayer, but then the state gets the full amount of money. And you have to imagine that helps some at the margin. And one other indicator of this is while you don't see specifically lobbies for state and local tax deduction outside of those congressional districts that are kind of focused on a congressional district, you might see it in national unions of primarily state and local employees. For example, the teachers union, say Randy Weingarten, the famous teachers union leader, she has been very supportive of the state and local tax deduction because she's kind of looking at this indirect bank shot of if it's less painful to raise taxes at the state and local level, well, then there might be more taxes at the state and local level, and that could mean that teachers could be paid more. So she's kind of seeing this long billiard shot where you're, bouncing it off one ball and hitting another. She's got all of that in mind, but really the direct effect of this is probably the dominant one to most people. If you're very specifically like a union representative for people who depend on state and local tax revenues, then yes, you care about the indirect effect. But for most people, it's just, do my constituents get a tax cut? And if you represent Northern New Jersey, SALT is a big deal to you. And if you represent suburban Indiana, it's not so much.
I think the other big part of fiscal policy that's on people's radars this year is tariffs. So this has been a huge part of how President-elect Trump plans to plug some of the revenue gaps from his proposed tax cuts. Now, can you give us a definition really of what a tariff actually is? Let's say I import a washing machine from China that has a tariff on it. Where does that tariff come in during the trade process? Does it come when I buy it initially? Is it paid at the end of the year by the business, or is it when it clears customs? What exactly is a tariff?
A tariff is a tax that doesn't either apply to all consumption equally or apply to all income from kind of factors of production equally. You can imagine if you tax all of the stuff that's consumed in your country, that's fine. If you tax all of the stuff that's kind of produced in your country, that's fine. Then you would do the former through something like a sales tax and the latter through something like an income tax. But if you instead come up with a kind of unprincipled system that goes after what is produced abroad but consumed here, if you do that without it being part of a broader consumption tax, that's kind of discrimination over where something is produced, even though what you're nominally doing is kind of more of a consumption tax. That's when other countries start to get mad at you. That's when it's a tariff. And tariffs can be remitted not just when like the final good or service is produced, but also if there's intermediate goods that come from other places kind of somewhere within the process. So it's not just like if you buy a Korean made washing machine, then you pay a tariff on the whole thing. It could also be like if there's tariffs on steel, and then the steel goes into an otherwise American made product, then there would still be tariffs paid on the steel import, and it would kind of make that American made product more expensive, even though the final good all has made in USA type labels on it. So really a tariff regime is not going to let you kind of sneak things through by including non-domestic content in something that's otherwise supposed to be made in America. They will catch you for that and try to tax you on it for better or for worse.
What can we say about who bears the cost of those tariffs? I mean, I think you described it well as essentially a tax increase by another name in many circumstances. So does that just get passed on to a higher price for consumers? Do corporations absorb lower profit margins? Do foreign producers lower their prices to stay competitive? I mean, I think that anyone who is in support of these tariffs can often state the benefits as, well, Americans won't be paying the cost of it. It almost sounds too good to be true. So what does the research say about who is actually bearing the costs?
The kind of basic economic micro model for this, when you're just looking at one industry or just looking at one transaction, we'll think about kind of a bigger tariff regime in a moment. But if you're thinking about just one market, just one kind of transaction, then what economists have observed is that the person who pays the tax is, in the end, is the person who kind of can't afford to walk away. We sometimes use a fancier word for that. We talk about who is inelastic versus elastic. But the idea is that some people are going to come to the table and say, well, we know that the tax is happening, but we still ultimately really want to make this transaction. And there are some people who might have other options and might be able to afford to walk away. And it really depends on who has more of that leverage. One example might be, say that Americans really, really like spices for certain foods that can only be made in, India and Indonesia and the like. But they really like those foods. The spices aren't that expensive to them. They're willing to shell out. If you were to put a tariff on that, I think you'd find that the spice makers, they have a lot of other willing customers, whereas Americans have no ability to grow those spices here in America because they don't have the right climate. So they don't really have other options. And there, I think you'd find that Americans would pay much of the tariff. But then if it's something where, say, American producers are competitive, then I think you'd find that people would be able to switch over to American producers, and you'd find that foreigners paid, the foreign producers kind of end up paying for much more of the tariff because they kind of have to eat the tariffs costs in order to be competitive against the American producers. So it depends. You could see Americans paying more of it. You could see foreigners paying more of it. Then there's additional complexity if you go to a broad tariff regime where lots of things are tariffed, which may be the direction Donald Trump is going, but we'll see.
And what can a president do unilaterally in terms of tariffs? I'm sorry. And what does it need? What does the president need congressional approval for? So the proposed tariffs on Canada and Mexico, for example, that President-elect Trump has announced, seem to violate existing trade agreements. On January 21st, can he just decree that these are the case, or is there a review process? Does Congress need to sign off on something? Can it go through the budget reconciliation process? What can Trump really do on his own?
Congress has, perhaps unfortunately, delegated a lot of its power on this to the president over the years. There are ultimately kind of three possible tools that the president can use that can be massaged and used to justify all sorts of policy. There's the idea of national security tariffs, things that impact national security. There's the idea of doing countervailing stuff against unfair trade practices by other countries. And then there's the idea of economic emergency. And the president can use any one of those three justifications. Those would go through Commerce, USTR, and Treasury, respectively. It's kind of funny that way. There's no kind of one single trade authority. Instead, there are kind of three. One thing that you'll notice about those justifications is that they're all kind of vague. And really, what is an unfair trade practice? Does anyone know? What is national security? Does anyone know? Congress might find that Trump has a lot of power already to do what he wants there. There are agreements that the US has made, especially with Canada and Mexico, that might constrain it. There's the USMCA kind of complaint process. And we make complaints against Canada. They make complaints against us. Some of those complaints are legitimate and eventually get resolved. But for the most part, we don't actually have agreements nearly as broad as the ones that we have with Canada and Mexico. So with Europe and Asia, Trump may have much more free reign.
I've got to imagine if I'm a company or even a foreign country that is quite impacted by new tariffs, and the wording of any agreements are vague, well, then it's going to go to the courts. And so if I'm a company in the US, let's say, that feels like some tariff imposed on my imports is really unfair, and I sue the government, does the tariff stand during that legal process? Is it up to the discretion of the court system? What happens in that interim period?
I think that can depend. Sometimes the kind of presumption is on the side of the government getting to do what it wants, and sometimes you can get a stay on something. I can definitely say that this sort of litigation is really costly, and sometimes it's kind of indefinite. There's kind of a funny case of the Canadian softwood timber producers have been in essentially constant litigation against the US Department of Commerce at least 20 years, maybe more. And essentially every trade lawyer I know who has worked in the private sector has at some point worked on the whole, commerce versus Canadian timber companies versus US timber companies. And so it can be very subjective. It can be very ad hoc. That has some advantages if you're kind of Donald Trump and your idea how to get policy done is you make a bunch of threats until people make some concessions. You have kind of the ad hoc abilities and you use them. That might make some sense from his perspective, but it also leads to, well, if nothing is fully set in stone, everything's a little bit vague, then we can argue about it for a long time rather than going back to actually producing real goods and services. So it's kind of like those people who work on trade law are often very smart, and really it would be ideal if we could have them working on something that wasn't so zero sum.
How about this idea that tariffs can help plug the shortfalls in revenue that come from other tax cuts? Now, the U.S. is a relatively self sustained and closed economy. You don't rely on trade as much as a country like Canada or the UK, which means not as many things are even flowing over our borders as a share of our total output. So, are tariffs a huge source of revenue, or is it really just a rounding error when you're talking about the rest of fiscal policy?
You've got absolutely the right insight. The US is just very, very large, especially large as an economy. We make tons of stuff here. I had to go to kind of the obscure example of Indonesian spices to come up with an example of something that we can't make here. The vast majority of our economy is about something that's produced by an American and then consumed by an American, and then it becomes someone, income for the American producer. And then that American producer himself becomes a consumer and spends on, once again, an American good or service. Tradable stuff is kind of rare, not super rare. I mean, you can think of a little bit in the way of European developed pharmaceuticals and software. You can think about a little bit in the way of imports of certain materials and commodities, and especially kind of low-level manufactured goods, cheap things like t-shirts, but it's not much. We don't trade that much value externally, and that's not because we aren't open to trade. It's just because the country's so big that there often isn't any need. So it's just a lot smaller tax base. And you don't necessarily have as much kind of international consensus around, you should be allowed to raise rates to 30% on tariffs, whereas, you can and already have a 37% income tax rate. It's just both a smaller tax base and one where historically like much lower rates are all that's tolerated. So given that, it's nowhere near to making up for all of the income tax, let's say, which people talk about because that was how we were in, say, 1905. We would have just tariffs and no income tax, but it's not really realistic for the size of government we have now. It may, however, be something like Republicans knock something off of the price of the TCJA extension by saying that they will raise some revenue from tariffs, but that's going to be hundreds of billions, not trillions.
I want to end with a kind of hypothetical question to you, very open ended, which is given the current tax environment we have in January of 2025, and given kind of the current stage of the macroeconomic cycle we're in, if you were to design your optimal tax policy, what would you say is the most effective policy change that you would make that would stimulate growth and kind of solve budget woes? And what is kind of the lowest hanging fruit for encouraging economic activity and not breaking the bank?
Probably the best bang for your buck within the existing system are the expensing of structures and equipment, the expensing of research and development costs, even though those things are often counted as kind of assets on the balance sheet and not as immediate losses by the firm. You want to look at these more from a cash flow perspective for tax purposes. And, on the statement of cash flows, they go out the door immediately. You want to have deductions to match the cash outflows. And that will encourage more investment, more research and development, that kind of thing. And those do cost money. Really, they're only a timing difference. We're saying firms should get the deduction earlier. There is a time value of money cost to that. It makes the government a little bit poorer to do. So on the other side, I'd say that probably the mortgage interest deduction is looking like the item that most deserves to be curbed. What we've seen experience with both the US limiting the mortgage interest deduction and also actually Denmark had a similar system and limited their interest deduction, is that it does a lot to bid up the prices of existing homes and not necessarily as much to facilitate new construction. So there's a lot of money to be had in the mortgage interest deduction. It's primarily taken by relatively well-off taxpayers. That's something I'd consider curbing further. and making it apply only to lower value and smaller homes. And you could get some revenue back there.
Alan Cole, thanks for coming on the podcast.
Absolutely. Thank you for having me.
That was Alan Cole, senior economist with the Tax Foundation's Center for Federal Tax Policy. To me, the most important thing to watch with tax policy this year is whether Republicans can manage to renew the TCJA's biggest provisions while still satisfying the non-trivial number of fiscal hawks in Congress. The acceptable margin of dissent within the party is incredibly small because of their thin majority in the House. Anything other than renewal will be a tax hike for most Americans, something no Republican wants to have on the record when the midterms come up in 2026. The December CPI next Wednesday is expected to show moderately slower core inflation after 4 months of data that have fueled concerns that price increases are not on a sustained path back to 2%. Even if the core increase comes in at 0.2%, as the consensus expects, the likelihood of a rate cut this month is still low. Also next week, December retail spending completes the Q4 consumption picture ahead of the advance release of fourth quarter GDP on January 30th. Before this morning's jobs report, the Atlanta Fed GDP Now model was estimating 2.7% quarterly growth. A handful of Fed officials are scheduled to speak next week before the pre-meeting communications blackout begins at the end of next Friday. Although there is little doubt the Fed will leave rates unchanged later this month, FOMC participants could chime in after the inflation or retail sales releases next week if there are any big data surprises. The following week, the Martin Luther King Jr. holiday will take traders away from their desks on Monday. Also that day, Donald Trump will be inaugurated as the 47th president. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.